As of 11:31 a.m. Eastern Time on this Monday, November 3, 2025, Nuburu Inc., ticker symbol BURU, is trading at 0.3074. That is a significant intraday drop, down just over 9.2% for the session, representing a loss of about 3 cents from its prior close. The stock opened at 0.3327, tried to push to a high of 0.34, but has since fallen to a session low of 0.3062 on heavy and concerning volume of nearly 35 million shares. Now, many traders looking at that price action, especially following the news from last Friday, might assume this is just profit-taking after the company announced the completion of the first phase of its acquisition of Orbit. But the reality of what is happening under the surface of this stock is far more complex and speaks to a deep-seated battle over the company's very survival. The expectation being sold to the market is a story of a high-tech pivot, a move from industrial lasers into the lucrative defense, security, and drone technology sectors. The reality, however, is a company with a market capitalization of roughly $40 million that is burning through cash, has negligible revenue, and is facing a significant and coordinated short-seller offensive that is betting this pivot is a house of cards. Let's first establish the common ground, the narrative that has drawn so many eyes to this sub-dollar stock. Most people who are trading BURU today are doing so because of the flurry of press releases. They see the announcements, a strategic alliance with Maddox Defense for drone technologies on October 22nd. The news on October 16th that the company had, for the moment, restored compliance with the NYSE American, and most recently, the October 31st update that it had completed the first phase of its acquisition of Orbit, a software company specializing in operational resilience. This paints a picture of aggressive transformation, of a company positioning itself to capture high-growth government and defense contracts. This is the expectation, a small-cap stock on the verge of a massive re-rating as it enters a new, profitable field. But this expectation is colliding head-on with the brutal financial and operational reality. This is not a story of a healthy company expanding. This is a story of a company fighting for its life. The NYSE American Exchange had already initiated delisting proceedings against Nuburu back in June 2024 because its stock price was too low. While the company submitted a compliance plan that was accepted in July 2025, giving it a lifeline until October 2026 to get its affairs in order, it is still trading with the .BC signifier, a scarlet letter from the exchange indicating non-compliance. Just last month, on October 13th, the company received another warning letter from the NYSE, this time for failing to properly notify the exchange about material news, specifically its implementation of a dual CEO structure before releasing it to the public. While they claim to have resolved this, it paints a picture of a company scrambling. This is where the short-seller thesis comes into sharp focus. The bet against Nuburu is not just that its blue laser technology failed to gain commercial traction. It's a bet that this new defense pivot is an attempt to create a new narrative unsupported by fundamentals. The most recent data shows Nuburu's short interest is a staggering 26.84% of the public float. That means more than 1 out of every 4 shares available for trading is being held by a short seller. These are not small, opportunistic traders. This is a significant, concentrated position. When you see a short position that high, you have to ask what they see that the bulls are ignoring. They see the income statement, a company with trailing 12-month revenue that is almost non-existent, reporting a net loss of over $37 million. They see the balance sheet, the negative equity, and the relentless cash burn that has forced the company into massive, value-destroying dilution. In the past year alone, the total number of shares outstanding has grown by an almost unbelievable 1,793%. This is the reality of how the company is funding its operations, by printing new shares, which crushes the value of existing ones. So, what's your take on this strategy? Comment below if you think this high-risk, high-dilution pivot into defense is a brilliant survival move or a final act of desperation. This brings us to the short-selling mechanics, which every investor in this name must understand. With a 26.84% short interest, many retail traders will immediately look for a short squeeze. However, the data here tells a different story. The days-to-cover ratio is only 0.26. Because of the stock's massive daily volume, like the 35 million shares we see today, it would take short sellers less than a single trading session to buy back all their shares and close their positions. This is not the setup for a traditional squeeze, where shorts are trapped. Rather, the high volume provides ample liquidity for them to get in and out. The off-exchange short volume ratio has also been consistently high, often above 55%, suggesting much of this activity is happening in dark pools, away from the lit exchanges, which can help mask large short positions being built or covered. We also have to look at the borrow fee rate, which is the interest rate short sellers must pay to borrow the shares. It's recently been around 8%. While that's high, it's not the 100% or 200% rate that signals an imminent, panic-driven squeeze. It's a high but sustainable cost for bears who are confident in their thesis. What's more concerning is the fails-to-deliver data from September, which showed multiple days with millions of shares failing to be delivered, a potential sign of settlement issues or naked short selling, though it's impossible to confirm without a regulatory investigation. For investors, this means you must be cautious. You can track this data yourself. Official short interest data is published by FINRA twice a month. You can also use specialized financial data platforms to look at daily borrow fee rates and the shares available to borrow list. If you see the number of shares available to borrow suddenly drop to zero and the borrow fee rate spike into the triple digits, that would be a signal that the pressure is building. But right now, the shorts seem to be in control, not in a panic. They are riding the stock down, and the heavy 35 million shares of volume today on a 9% down move suggests more selling than covering. What's your opinion on the short activity? Do you think that 26% short interest is smart institutional money betting on failure? Or is it an over-leveraged position that could be vulnerable to a news-based spike? This brings us back to the company's core business and this new pivot. Nuburu's original promise was its blue laser technology. This technology is genuinely interesting. Blue light is absorbed more efficiently by metals like copper and aluminum than the infrared lasers that dominate the industry. This allows for higher quality, spatter-free welding, which is a huge deal for manufacturing electric vehicle batteries, e-mobility components, and consumer electronics. The expectation was that this superior technology would be adopted by major industries, leading to explosive growth. The reality is that the company has been unable to commercialize this at scale. The revenues never materialized. The company's financials for 2024 and 2025 show a near total collapse in sales. So the company is pivoting. It's now Nuburu, the defense and security company. This is where the story gets even more complicated. The new acquisitions like Orbit are intended to build this new identity. But investors must look closer. The press release from last week about the Orbit acquisition noted that this was a related party transaction. Orbit was wholly owned by Alessandro Zamboni, who also happens to be Nuburu's own executive chairman and co-CEO. The transaction was reviewed by an external advisor and approved by independent directors, as it must be. But this is a massive red flag for corporate governance. The company is using its precious, hard-raised capital raised by diluting shareholders, to buy an asset from its own chairman. This is the kind of activity that attracts short sellers like sharks to blood. Looking forward, the tension between expectation and reality is clear. The bullish expectation is that this pivot works, that the combination of Maddox Defense's drone hardware and Orbit's resilient software will create a new, synergistic platform that can win multi-million-dollar defense contracts. If Nuburu announces a single substantial contract from the Department of Defense, this stock will fly, and the 26% short interest will be forced to cover, creating a massive, albeit likely temporary